Oh yeah, system is not liquid. Normally it would have been system liquidity chasing a few securities and dragging down yields, but that's not the cause. The issue here is that there's been some kind of oversupply at the long end, where over time securities between September and then January have been issued consistently at the OMO auction in very huge volumes. And what's happening is that for investment houses, banks, asset managers who have funds to play on the short term, they've had to rely on the secondary markets to cover this position. So yields have dragged down from 13.5 to 11 and 10% levels. On certain maturities, we actually saw yields drop to as low as 8%, 9%, even though those were knee-jerk. For position holders who had those securities, they simply sold into those yield drops and then brought them back to 10, 11%. So basically, it's oversupply on the long end, and most surplus units coming to cover their positions or their obligations for these maturities at the secondary market. I'm referring to securities between 14 days to 180 to 200 days. The yields have depressed seriously.
Do you think this is going to continue, or could we see normalization going forward?
If you look at the issuance pattern at the primary and the OMO auctions, you'll see that there's more focus on raising one-year securities. We're not issuing so much of 91 and 180-day bills. So usually when the demand comes of maturities for treasury bills for 90 days to 180 days bills, they rely simply on the secondary market. So it gives a lot of activity and fluidity and room for arbitrage, and so basically it's expected to continue given the issuance patterns we've seen.
Okay, let's move over now to the bond market. We had that auction last week. How has the market performed so far this week?
Okay, we saw very huge demand at the market, especially on the 2028 bond, which topped at 15.35%. It was expected that rates could end up higher than that, but we saw that demand was so much, they sold 91 billion. The amount on offer on that particular maturity was 50 billion. 50 billion was offered for 3 different maturities, but the DMO ended up selling 6 billion for 2023, 20 billion for 2025, and 91 billion for the 2028, which trades at the secondary market. The demand, honestly, I can say it's because of the coupon we've received so far. It's coupon season for most of FGN Nigerian bonds. We've received over 300 billion in the last 6 weeks. Most of these funds will find its way back into the reinvestment into FGN bonds, of course, into different classes, different times. So basically, besides FPIs coming in and for fresh funds finding its way into the markets for new year investments, it's coupon driven. What we're seeing, the activity level and the demand we're seeing in the bond market is coupon driven. Next week, we expect about 60 billion also to come in, besides the 300 billion we have received so far.
That's a lot of liquidity for the system.
Oh, yeah. But it continues OMO, where the central bank will usually take out these funds. Of
course, Apex Bank is waiting with those OMO auctions. Now, let's move over now to the FX market, especially performance at the I and E window. What have we been seeing since Monday?
Convergence continues. If you look at the rate at the wholesale market, 357.25. At the parallel markets, also ranging between 357 and 360. The I&E has dropped further from 362 to 361, 25, 50 levels as we continue to see continuous supply from non-oil exports, as some oil exports proceeds also. Demand is not really huge, probably because most industries and companies are still, trying to kick off the new year. Of course, we know that most of our Asian counterparts are enjoying their new year, Chinese New Year, Year of the Pig. So we expect that as activities kick up, there will be more demand. But right now, it looks like the supply at hand is sufficient. Well, the currency is stable, actually.
Okay, that being said, we're actually a lot closer to the elections now, and I'm trying to remember the situation we were in 2015, just ahead of the elections, this time in 2015, and how the naira was performing against the dollar. I'm just thinking that, the fact that we're so much closer to the elections now, perhaps there might be the possibility of those spikes. Do you see that happening, or Are you surprised that the naira is this stable and actually, even strengthening against the dollar?
Oh yeah, we are not surprised. The factors that drove rates in 2014, 2015 are not present this time around. What we saw then was the major factor was crude oil crash. Prices started dropping. Of course, this continued into 2015, 2016. And then the external reserve took a hit, also dropped below 30 billion levels. We have not seen crude oil price crash, even though we've seen a drop from 80 to 62 levels that we are presently. The external reserves has been maintained, currently 43 billion. The only constant issue is the political risk. And from some watchers who think that both entities at these elections are known, the former vice president and the perennial contestant, former contestant in President Buhari, who had simply gone to court when he lost in the past. So these entities are known and from the same region. So it looks like the political risk and the anticipation of negativity is tapered, honestly.
Bankole, thank you so much for talking to us today. We appreciate it.